Imagine if just one wrong investment decision cost you your entire savings. Sounds terrifying, right? Let's face it, 2025's financial landscape could be more unpredictable than ever. So, how can you sidestep the traps of risky investments and dangerous stocks? Start by understanding that not all glittering stocks are gold. In an era where headlines scream about the next big thing, it's crucial to focus on the fundamentals instead of getting lured by hype. Consider the classic formula. Before diving in, analyze the company's health. Look at its debt levels, earnings, and the strength of its management team. Many investors make the mistake of jumping on trendy tech stocks without checking if the companies actually have sustainable business models. Another point to ponder is diversification. Putting all your eggs in one basket or one stock might feel rewarding initially, but it dramatically heightens risk. Spread your investments across different sectors to cushion potential shocks. Thinking about market sentiment can also be a game changer. Investor emotions often lead to volatility. By staying informed and not swayed by the emotional market tides, you can make more objective decisions. But where do you start? Well, it begins with focusing on the data and trends, not just the storylines. Let's dig deeper into those trends. In 2025, geopolitical events, technological shifts, and climate changes aren't just headlines, they're catalysts shaping markets. So, keeping an eye on global events is more critical than ever. The ripple effects of a trade policy change or a breakthrough in green energy can drastically impact stock values, often in ways that aren't immediately obvious. Risk management is your safety net here. One way to minimize risk is by setting clear investment goals and sticking to them. Establishing stop-loss orders can prevent you from holding on to a losing stock for too long. These orders automatically sell a stock when it falls to a certain price, limiting potential losses. Have you heard of the herd mentality? It's the tendency to follow the crowd, particularly in trading. It's easy to get swept up when everyone seems to be buying or selling, but that's when you need to step back. Opportunities often lie where others aren't looking. Also, understanding your own risk tolerance is crucial. Are you comfortable with fluctuations, or do you prefer stable growth? Knowing this helps tailor your portfolio to match your comfort level. Ultimately, investing isn't just about profits. It's about prudent decision-making. We'll explore more strategies to navigate these waters, coming up next. Let's touch on another vital concept: the art of patience. When market conditions are rocky, the temptation to react impulsively can be overwhelming. But often, the best course of action is to do nothing and let the storm pass. Historically, markets tend to correct themselves over time. Those who panic and sell in a downturn frequently lock in losses instead of riding the recovery wave. Now, let's consider the role of technology in your investment strategy. Robo-advisors and AI-driven analytics are becoming more common and can provide real-time insights that were once the domain of financial analysts. They can analyze massive data sets to spot patterns and trends that might elude the human eye. Utilizing these tools not only enhances your decision-making process, but also keeps you ahead of the curve. Building a solid understanding of financial statements and market indicators can further fortify your investment strategies. Metrics like return on equity or price-to-earnings ratio offer insights into a company's performance and value. Finally, never underestimate the power of a seasoned financial advisor. While tech tools provide data, a professional can offer perspective and guidance tailored to your specific situation and goals. Remember, a strong strategy combines knowledge with insight. Armed with these tactics, you're better equipped to identify and mitigate risks in your investment journey. Ready to discover more strategies? There's still plenty to explore. Let's delve into another key aspect: emotional discipline. Investing is as much about mindset as it is about strategy. Emotional decisions often lead to poor outcomes. How often have you heard that a stable mindset can make or break an investor? Fear and greed are powerful motivators, but they can cloud judgment. One approach to managing this is adopting a systematic investment plan. By investing a fixed amount regularly, regardless of market conditions, you can avoid the pitfalls of trying to time the market. This strategy, known as dollar cost averaging, reduces the impact of volatility and can lead to more consistent returns over time. Let's turn to the importance of continual learning. The investing world is always evolving, and staying informed is essential. Reading financial news, attending seminars, or joining online forums can expose you to new ideas and emerging trends. The more knowledgeable you are, the more confident you'll feel when navigating tricky investment waters. And remember, mistakes are part of every investor's journey. Each mistake is a learning opportunity, so don't shy away from analyzing where things went wrong. Over time, this reflection helps refine your strategy and strengthens your risk management skills. By cultivating emotional resilience and a commitment to learning, you establish a robust framework for long-term success. Ready to take the next step? Let's continue to forge ahead on this investment journey. Let's talk about leveraging community insight. Engaging with investment communities can provide a wealth of knowledge you might not find elsewhere. Online platforms are brimming with seasoned investors sharing their analyses and experiences. However, it's crucial to sift through opinions with a critical eye. Not all advice is sound, so cross-reference tips with reliable sources before acting on them. Consider how history can be your guide. Looking at past market trends can offer valuable lessons. While history doesn't repeat itself exactly, it often rhymes. Recognizing patterns from previous market cycles can help anticipate similar movements in the future. It's about building intuition based on the past while remaining adaptable to new conditions. Next, let's consider the advantage of niche investments. Sometimes, stepping away from mainstream stocks to explore under-the-radar sectors can reveal hidden opportunities. Industries like renewable energy, biotechnology, or emerging markets often contain gems poised for growth. But remember, niche investments come with their own set of risks. Thorough research and understanding of these sectors are essential before jumping in. Balancing your portfolio with a mix of mainstream and niche holdings can help mitigate these risks. Ultimately, successful investing requires a blend of research, intuition, and community input. As you continue to explore this landscape, keep your strategy dynamic and responsive. Are you ready to diversify and discover even more untapped potential? Let's keep pushing forward. Having explored the diverse strategies to steer clear of risky investments and embracing sound risk management practices, let's remember the core takeaways. Diversify thoughtfully, harness technology and community insights, learn continuously, and manage your emotions. Now, I challenge you to reevaluate your current investment strategy and see where these tips might fit in. By doing so, you pave the way for a more secure financial future. If you found this guide valuable, make sure to hit that subscribe button and join our growing community. You'll get direct access to more insights and strategies designed to empower your financial journey. Remember, smart investing is just one click away.